Welcome to the channel. If you've ever wondered how the world's most successful investors made their fortune, you're in the right place. In today's video, we're diving into the minds of some of the greatest stock market legends to ever walk the earth. From the value investing genius of Warren Buffett to the daring risk-taking strategies of George Soros, these investors have built empires, made billions, and completely changed the way we think about money and markets. But what's the secret to their success? How did they do it, and what can we learn from their journeys? Well, today we're breaking it all down. Each of these legends has their own unique approach, but they all have one thing in common: a mindset that's transformed them into legends. So, whether you're just starting out or looking to refine your own investing game, stay tuned, because you're about to learn the strategies, the tips, and the mindset that could make you the next stock market legend. Let's get started. 1. Warren Buffett, the Oracle of Omaha. Background: Warren Buffett is arguably the most successful and well-known investor in the world. Known for his value investing strategy, he turned an initial investment of $100 into a net worth of over $100 billion. Key strategy: value investing. Buffett focuses on buying undervalued companies with solid fundamentals. He looks for businesses that are easy to understand, often called moats, with consistent earnings, a competitive edge, and good management. Long-term thinking. Buffett famously said, "Our favorite holding period is forever." He believes in buying stocks as if you were buying the whole company and holding them for the long term. Focus on quality. Buffett avoids speculative investments and only buys into companies that he believes will continue to grow and prosper over the long run. Lessons for success: invest in what you understand. Focus on the long term and avoid getting swayed by short-term market fluctuations. Always have a margin of safety in your investments, i.e., buying at a price that offers room for mistakes. Advice: price is what you pay, value is what you get. Be fearful when others are greedy, and greedy when others are fearful. Focus on long-term investments and avoid short-term market fluctuations. 2. George Soros, the man who the Bank of England. Background: Soros is best known for his speculation against the British pound in 1992, which earned him over $1 billion in a single day. He is a highly successful hedge fund manager and philanthropist. Key strategy: global macroeconomics. Soros specializes in global economic trends and uses these to predict the direction of currencies, commodities, and entire economies. Reflexivity theory. Soros's theory posits that market participants' biases and misperceptions can create feedback loops, influencing economic reality. He uses this insight to predict major shifts in financial markets. Risk management. He is known for his rigorous risk management practices, often betting heavily on a single trade when he's confident, but cutting losses quickly if things go wrong. Lessons for success: understand macroeconomic factors and global trends. Don't be afraid to take big risks when you have high conviction. Cut your losses quickly. Don't let a bad trade turn into a disaster. Advice: it's not whether you are right or wrong that's important, but how much money you make when you are right and how much you lose when you are wrong. The more I see, the less I know for sure. Be adaptable and embrace uncertainty in your decision-making. 3. Peter Lynch, master of the Magellan Fund. Background: Peter Lynch is a legendary investor, known for managing the Fidelity Magellan Fund from 1977 to 1990, during which he achieved an annualized return of 29%. Key strategy: invest in what you know. Lynch is famous for saying that everyday investors can have an edge by investing in businesses they are familiar with, like the stores they shop at or the products they use. Growth at a reasonable price. GARP. Lynch combines value and growth investing by seeking out companies with strong growth potential, but still trading at reasonable valuations. Diversification. Unlike Buffett, who focuses on a few high-conviction stocks, Lynch believed in holding a broad portfolio, around 1,000 stocks at one point, to spread risk. Lessons for success: don't overlook the value of personal insights and experiences. Look for undervalued stocks with strong growth potential. Diversify to manage risk while still achieving substantial returns. Advice: invest in what you know. The real key to making money in stocks is not to get scared out of them. Pay attention to the fundamentals of the company and industry. 4. Benjamin Graham, the father of value investing. Background: Benjamin Graham is the mentor of Warren Buffett and the author of The Intelligent Investor, one of the most influential books on investing. Key strategy: value investing. Like Buffett, Graham focuses on buying undervalued companies based on financial analysis. He introduced the concept of the margin of safety, which refers to buying stocks at prices significantly below their intrinsic value. Investing in fundamentals. Graham taught that investors should focus on a company's financial statements, such as earnings, dividends, and assets, rather than speculative market trends. Defensive investing. He advocated for a more conservative, less risky approach to investing, particularly for those who are less experienced in the market. Lessons for success. Do thorough research and focus on intrinsic value rather than market trends. Always protect yourself with a margin of safety. Stay calm during market volatility and avoid speculative investments. Advice. The intelligent investor is a realist who sells to optimists and buys from pessimists. Investment is most intelligent when it is most businesslike. Focus on the intrinsic value of companies and ignore short-term market movements. 5. Jesse Livermore. The boy. Plunger background. Jesse Livermore is considered one of the greatest stock traders in history, known for making millions in the early 1900s, particularly during market crashes. Key strategy: speculative trading. Livermore made his fortune by speculating on market trends and timing the market. He's known for short selling during the 1929 stock market crash. Market psychology. He understood the importance of market psychology and used it to gauge the best moments to buy or sell, cutting losses and letting profits run. One of Livermore's core strategies was to cut losses quickly when trades weren't working out, but allow his winners to run for as long as they continued to move in his favor. Lessons for success. Timing the market requires understanding market psychology. Be disciplined, cut losses early and let your winners grow. Have a well-defined strategy and stick to it. Advice. It is not the strongest of the species that survive, nor the most intelligent, but the one most responsive to change. Don't forget the market trend. Patience and timing are crucial. Do not chase the market, but wait for the right moment. 6. Carl Icahn. The corporate raider background. Carl Icahn is a billionaire activist investor who made his wealth by taking large stakes in companies and then pushing for changes to increase their value. Key strategy: activist investing. Icahn buys large stakes in underperforming companies and uses his influence to push for changes, such as restructuring or cost-cutting, to unlock value. Understanding corporate value. He looks for companies with hidden value that are not being fully realized by the market. Aggression. Icahn is known for his aggressive approach to influencing company management and making bold moves to restructure or sell off assets. Lessons for success. Be willing to be bold and take control of a situation when necessary. Look for hidden value within companies and industries. Activist investing can be profitable if you have the right influence and strategy. Advice. If you are not making mistakes, then you are not doing anything. Don't be afraid to go against the crowd. Investing is about finding undervalued assets and forcing companies to realize that value. 7. Ray Dalio, founder of Bridgewater Associates. Background. Ray Dalio is the founder of Bridgewater Associates, one of the world's largest hedge funds, and the author of Principles, which lays out his investment and life philosophies. Key strategy: principled decision-making. Dalio emphasizes the importance of principles in both investing and life. His investment approach is built on creating systematic rules based on historical patterns and economic principles. Diversification and risk parity. Dalio is known for his focus on risk parity, balancing risk across different asset classes. His pure alpha strategy aims to generate returns that are not correlated with traditional market movements. Understanding macro trends. Dalio focuses on understanding the macroeconomic environment, particularly economic cycles, debt crises, and global shifts, to predict market movements. Lessons for success. Have a set of guiding principles to help you make decisions, especially under pressure. Diversify to reduce risk and focus on non-correlated assets. Always consider the bigger economic picture. Advice. He who lives by the crystal ball will eat shattered glass. Understand that the biggest risks is not understanding risk. Focus on risk parity and balance your portfolio to protect against market volatility. 8. Philip Fisher, strategy. Growth investing. Focus on quality companies. Success formula. Fisher is known for his in-depth analysis of a company's management and long-term growth potential. He focused on companies that could grow for decades and looked for high-quality business. Advice. The stock market is filled with individuals who know the price of everything, but the value of nothing. Invest in companies with good management and long-term prospects. Buy into a company with an established, well-regarded management team. 09. Charlie Munger, mental models and rational thinking. Success formula. Munger, Buffett's longtime partner, is known for his interdisciplinary approach, using mental models from different fields, psychology, economics, etc., to make better investment decisions. Advice. The big money is not in the buying and selling, but in the waiting. Spend each day trying to be a little wiser than you were when you woke up. Diversify your thinking and approach problems with a wide range of perspectives. Well, that wraps up our look at the stock market legends and their secrets to success. Hopefully, you've picked up some valuable strategies to apply to your own investing journey. Remember, whether you're inspired by Buffett's long-term vision or Soros's macroeconomic approach, success in the market is all about staying disciplined and learning from the best. If you found this video useful, don't forget to give it a thumbs up. It really helps the channel grow. And if you haven't already, make sure you subscribe for more tips, strategies, and stories from the world of investing.